Longer-term bonds, they perform better in the 3 months after the last rate hike than shorter-term bonds historically. So 2 questions for you. Do you think we've just or saw the last rate hike? Are we officially in a pause and headed towards a cut? And do you believe that trend can occur right now in this current inverted environment?
Well, I do think that we've seen the last rate hike. I think for me, the big open question is when will we start to see cuts, or when will we get more clarity on what will lead to cuts happening? And so I think that timeline is very critical. I think it's great news that we've mostly solved inflation. I think it's great news that the Fed is at, in my opinion, or close to a pause. But we do have a lot of uncertainty on the path ahead for the Fed and when they'll start to look to cut those rates back a bit.
All right, so Robert, when you say we, who's the we right here? Because I just heard Jay Powell say that inflation's still way too high, core PCE at 4%. The Fed's target, obviously, 2%. We have the PCE report coming up this week on Thursday. So if you feel like we solved inflation, is PCE, is that still a market mover?
Well, I think that's one of the reasons we're in a holding pattern on stocks here. So I think that from an equity investor standpoint, inflation has mostly ceased to be a problem. So whether it's CPI or PCE, they've come down a lot. The trend has been in the right direction. They may remain stuck above the Fed's 2% target for a while. And therein lies the problem from a Fed perspective. So the Fed is very resolute in maintaining that 2% target and not willing to take action until we get there. And so I think a lot of the positive gains that we've had this year are sort of coming to an end here and fizzling out because we lack clarity on what will cause the Fed to act next.
So I just want to ask you again, though. So is PCE, is that still a market mover? Is that something that's going to influence the markets? And are you advising your clients to position a certain way ahead of it? Because, you know, you would think it's going to give us some insight in the Fed's path.
Yes, I do think PCE is very important, and you're right. That is the key metric for the Fed. So it is lagging a bit behind CPI in terms of how it's coming down. It is a little bit stickier, and it is what the Fed's focused on. So I do think it's critically important for insight into how the Fed's going to proceed from here. And it's one of the reasons that they've maintained this posture of being so resolute and keeping rates where they are, because metrics like PCE, which are so important, remain elevated.
So does it change your view on equities, knowing that we have this potential big inflection point coming up? Are you advising clients to move into something different? I mean, just give us a sense of how you see this if you think it's such a big market mover.
Sure. Well, I think in the short term, things are a little bit choppy here, and I think they'll remain that way until we begin to get a little bit more clarity on the Fed. I prefer to take a little bit of a longer term view and step back and think about, what happens when we start rounding the corner into next year. And markets traditionally after Labor Day start to focus on the upcoming year. I think the outlook for the upcoming year looks a little bit better. But here in the short term, yes, we are very much wedded to short term metrics such as when PCE or CPI come out. In 2 weeks, CPI will be another market moving metric. And I think both of those are unlikely to provide any clarity or great optimism for equity investors here in the short term.
All right, since you're looking long term and you think that we're headed towards a pause and then a cut, doesn't that make growth stocks more attractive right now? So if we see some weakness when it comes to the Magnificent Seven or some of these other mega cap tech names, wouldn't that be an opportunity to buy?
It is. I think that because we've sort of hit a ceiling on valuation here, and the reason I think we've hit a ceiling on valuation is we're unlikely to see cuts from the Fed anytime soon, not until the middle or late part of next year. And so because of that, valuations are capped here. So therefore, I look to the earnings side and say, where are we getting earnings from? Tech is certainly one of those areas. I think investments in productivity enhancing technology are likely to lead to a nice CapEx cycle, which benefits some of the technology space. And then I think you have a very strong job market, which makes things pretty compelling from a consumer discretionary standpoint. There is still runway there. There is still spending. Those companies are still continuing to earn well. And then we've seen a lot of focus on U.S. manufacturing, and that's benefited the industrial sector. Those monies are still flowing through the economy, and that's leading to earnings in that space as well. So I've been more on a follow the earnings message here and not looking for any positive incremental developments on the valuation front until middle of next year.